Joining us to discuss his outlook for crypto is Arjun Sethi, who is the co-CEO of cryptocurrency exchange Kraken, which has recently closed a $500 million funding round and has also launched a new payment card. And of course, our very own Arjun joining the conversation. Thank you very much for joining us today. Your company has been so busy in a space where there's been huge demand for crypto. Last year or so, multiple acquisitions, Small Exchange, Ninja Trader, Breakout, Capitalize AI. Does that mean you're trying to consolidate the sector as you see opportunities for larger is better in a fragmented market?
Thanks for having me. No, I mean, the way to think about crypto is a lot of people think of it as an asset class. We think of it as a technology rails. And so when you have technology rails that can give people access to cryptocurrencies, equities, commodities, et cetera, we're sort of converging those two asset classes together.
Arjun, I just want to just get a sort of broader take on what's happening in the markets right now. We've sort of seen a lot of pressure on cryptocurrencies very recently after some of them have had some pretty big run-ups. What's going on at the moment?
Yeah, I mean, you know, there's always this conversation about day by day what's happening in the crypto markets or equity markets, or quarter by quarter. If you take the long horizon, which is last year, we were at 65,000 or 68,000, and then we went to 100, then 120, and back to 100. I just think of price volatility at this scale has a ton of volume, and so it's a sign of market maturity, not necessarily, hey, this is like an asset class that's less volatile. More and so it's cryptocurrencies. Again, you go back to the rails. You've got BTC, ETH, USDT, USDC, now tokenized equities. You have a ton of asset classes coming into the system, and a ton more capital.
Where are we in that process? Because I've heard for a long time about tokenized assets for sure. You're launching a new payments card, which will allow people to spend with crypto as well, which is something many have spoken about for a long time, hasn't quite taken off. Mm-hmm. Where are we at sort of adoption of crypto assets in the real world on both the retail front, but also the institutional front as well?
Yeah, so I never usually like using the word retail or institutional because it kind of deminimizes what an average everyday consumer does. Just so take a look in the UK, like 1 in 5 people are using cryptocurrency in some capacity, either as DeFi or centralized. And in the world, you already have over 1 billion people using it on a daily basis. So what are they doing? They're sending, receiving, storing, and getting yield that most people that are, let's just say, at the upper echelon get access to in terms of yield. They don't get that here for other traditional products. So the way to sort of think about it is that you have multiple adoption paths in multiple areas with multiple products. And so instead of thinking about it as crypto, it's just that I have access to assets. And now that my collateral is mine, it's sovereign in some sense or free, that I can use it now for everyday use cases, which is buying coffee or going grocery store shopping.
So just talk to us about why now the time to launch these sort of cards. Is this a banking product you're offering at this point?
Yeah, I mean, banking and financial services is a huge misnomer, right? Which is, what do? They just give you access to capital and then access to transact. Crypto is just, you're moving your collateral into the crypto rails ecosystem. So neobanks are adopting crypto rails. Traditional crypto native companies are doing the same thing. So it's really just about giving people access to their assets so that they can do something with it. Again, which is sending, receiving, transacting, or getting some sort of investment yield.
There's a big conversation happening right now about where we are at the current, I guess, crypto cycle, as it were, how it differs to the previous crypto cycle. One of the things investors are quite focused on right now is the altcoins, right? The ethers of the world and others, mm-hmm. and whether we're going to be entering what many dub an altcoin season, right?
Sure.
So far, we've seen big run-ups in some of the major altcoins, the likes of Ether, but not necessarily in the long tail of other altcoins that are out there, which seems something that's very different to what happened last time around, where the rising tide kind of raised all the boats.
Yeah.
What's happening right now?
So traditionally what happens is that when you've got a really small asset class, it becomes very volatile because you have less participants. So just typical supply and demand theory. Now you've got, instead of millions, you're getting into billions of people that are interacting with crypto. So volatility becomes less, and then a certain set of assets within the long tail become less desired. So BTC, ETH is what we hear all the time. ETH is not an alt. It's part of the core. And so the way you can think about it as power law is that even in the public markets, we talk about like 10 companies. We don't talk about the other 3,000. And then there's the bifurcation between public companies and then private companies. Alts are in the same way in that like the first set of alt, utility coins or commodity coins that are coming out, those are the early phases of a private company. As they scale and get larger, then you start talking about it, similar to what you heard about Hyperliquid, which is it didn't exist a year ago, but we're talking about it now because they scaled at a certain rate.
Can I come back to something you said about retail versus institutions? You said you don't like to differentiate on that basis, but I would push back that the impact that institutional investors can have on a market is significant compared to individual retail investors. So why does it make sense not to divide them that way when we've been told for years now that it's the institutions that will really change the crypto market through their involvement?
Yeah, I think it's, well, I take a step back where I don't like sort of putting labels on people, which is what does the average everyday individual that's like 25 to 30 doing, male or female? So what does a consumer want, and what are the access to products that they want? I think the way to sort of think about crypto in the first place is that it came from a distrust of institutions that pretty much did not fulfill the needs of what they were promised to. Right? So I think about fractional reserve banking and sort of how that's failed not once or twice, but like tens of hundreds of times over the last 200 years. And so crypto came about from consumers basically saying, hey, we're kind of fed up with institutional trust. And so I want to be able to move my collateral into something that I own and that I trust. And so institutional capital is coming into crypto, but it doesn't mean they own it. It's just that a lot of the innovation starts with the consumers, the product starts with the consumers, it serves them and their needs, similar to the products that we build. And so when I say consumers, I say it's like there are customers, and then institutionals are a different set of customers. Retail versus consumer, it makes it sound like there's a fight between the two.
Right. Let me ask you about where we sit in the cycle, because it was only a few years back when Arjun and I were at Money 2020, and a lot of the payments companies were telling us they just could not make crypto work as a transaction. It's very, very difficult. We know that a lot of banks have been working with the underlying technology being blockchain, and it was only about a day ago the CEO of Standard Chartered said to us on CNBC that eventually he saw blockchain powering nearly all global transactions.
Yeah.
A bold call. Do you see that, and how far away are we from that being a possibility?
So, look, I think in the 1990s, people started using the word .com, and then their stock price rose. And then people started talking about the internet, and then they started talking about mobile, and so they would just add some sort of what I call technology as a way to sort of differentiate themselves. If you really ask in my opinion, any CEO of any large, Fortune 500 company, what is blockchain? How does it work? Is it decentralized? Not what's the block time look like, or what's the technology that you use? I would be surprised if they could answer that question. That's one. Two is I think it's an easy way for them to say yes, we're adopting technology, but then they're not. It's the same way you think about machine learning or AI or any sort of system in order to make your company more efficient, which is what they would say. But I think what's more important is that look, these technologies are going to give people access to creating more products, interacting with them more, and actually just creating more jobs for them where they don't have in the first place. So, is it happening? Yes, it's happening bottoms up. Now institutions are trying to figure out, should we use crypto in our company or not? Should it be for stable coins? Should it be for treasury management? Should it be for expense management, et cetera, just your traditional banking and financial services? So I think, look, the institutional companies, they're trying to figure out how to catch up because they haven't built any tech. They're still in post-World War II brick and mortar systems, and they're still using like Excel sheets from like 1995.
Arjun, thanks for joining us in studio. Great to hear from you. Please join us again. Arjun Sethi, co-CEO of Kraken, and Arjun, our very own Arjun, thank you as well.